The VIX is sliding lower and lower. The stock market's been moving upward after a couple days of volatility. So if you are someone who has volatility trading strategies that involve looking for bottoms on, say, UVXY or the VIX, I wanted to break down what we've got going on in the future. First off, the economy is shifting. The Federal Reserve needs to keep interest rates higher for longer. At the same time, the Federal Reserve very likely is going to have to maintain that position because they're not going to want to make any kind of moves just before the presidential election. They don't want to sway the markets or the economy in such a way that would look like they're playing favorites on the presidential election, which means interest rates are really going to be brutally high for a while. At the same time, we're watching the consumer slowing down. The stock market, which has hit all-time highs, has been moving back upward, but I think that's done. I'm looking for a stock market crash. So if you're someone who has volatility trading strategies that involve looking for bottoms on the VIX, UVXY, the ETF for the VIX, these charts I've got for you are going to break everything down and show you how we're probably going to see a big spike in the VIX, which means your volatility trading strategies are going to really start to pay out. I use stock options when I trade UVXY. I look at them as kind of lottery tickets. When the VIX is down as low as it is right now, they turn into lottery tickets. We don't have anything this week, but you want to start moving in towards the end of next week or the end of this week going into next week when we have economic data that's going to continue to show that the economy is slowing down because of the high interest rates. Stocks will sell off. Let me break down a few charts for you to kind of sharpen the pencil for your volatility trading strategies. Let's jump in. Here we're looking at the VIX itself, which is the volatility index versus the stock market or the S&P 500. For me, volatility trading strategies involve first looking at this. I look at a symbol called PCC, the put call ratio. I've got that chart. That's really important because it shows sort of the mathematics behind the volatility index or the VIX. When we get the ratio that's ultra low and we've got economic data that looks like it's going to be negative for the economy, that's when I step in and buy the VIX. Right now the VIX sliding, if we go back down to about 12 on the VIX, that's pretty low on a historical basis. So I'm not sure what the next bit of economic data is, but we do have some coming out. The main ones are, of course, employment, which we just got last week. Employment numbers were a bit soft. Inflation, we get actually CPI data will come out next week, and that should push the stock market downward because we continue to see inflation numbers moving higher and higher, which says the Federal Reserve has to keep those interest rates higher. I always get involved in the VIX, or in this case, I use what's called UVXY, which is the ETF. This is my volatility trading strategies right here, is basically getting into UVXY and then buying calls on this. It's trading right around 29. If we continue to slide going into, I think the number comes out Wednesday, Tuesday, Wednesday, Thursday, and I'll get, I usually start in maybe Monday or Tuesday if there's a Wednesday or Thursday trade expiration that week. What I'll be looking for is stock options, maybe a week or ending that week or the following week, depending on how low things go. But UVXY is trading at 29. There was a split just before the 15th of April. We could see a spike back up to, say, 40, which those, as of right now, for next week, are trading at about 25 cents. Now, next week, I might be able to pick up 35s for 20 cents, given the amount of time that I'm looking for, expiration date, and things like this. So my volatility trading strategies are always very short term. I'm looking to buy stock options on UVXY based on an economic data point coming out that week that shows that we're seeing inflation numbers or unemployment softening or whatever the economic report may be, looking for a spike in the VIX. Now, here's another thing. Once we see that spike, the market just seems to turn right back around. This is SVIX, SVIX. It's the opposite of the VIX. So if you wanted to go short the VIX, this is one of the ways that you could do that by buying SVIX stock. When volatility calms down, the stock market kind of keeps moving a little bit higher and higher and higher. I typically will step in and buy maybe some calls on this or sell some puts and buy calls. I tend to do what's called a risk reversal. It's a risk reversal. It's a stock option strategy that I like. Very profitable for me. I usually don't like just buying calls or buying puts on something without selling something against it. It's a little more commitment, but it's also money coming in to pay for whatever I'm buying. That's one of my volatility trading strategies. But in this case, SVIX, it's pushing up about as high as it's going to go. And in this cycle, and what I'm expecting is continued economic data points, CPI next week, of course, showing that there's still inflation. The Federal Reserve isn't going to be able to move. It keeps reiterating. All the economic data we keep getting, it just reiterates more and more that the Federal Reserve can't do anything, but these ultra high interest rates are making the consumer contract. Expenditures are falling, which means stocks need to go lower because revenues are just simply not going to be there. Here is SVIX versus the stock market. SVIX, of course, it's the opposite of the VIX. When the stock market calms down, SVIX goes up. We're pushing back upward close to, say, the highs that we saw, it was about a month and a half ago, in the stock market. I have been looking and searching. My volatility trading strategies right now are basically looking at UVXY, going into these economic reports with the idea that the economy is slowing faster than the stock market wants to believe, and that the long-term effects are we're going to have a stock market crash. And I just put a video up on that yesterday regarding that. So if you want to see my thoughts on that. But taking advantage of spikes in volatility, one of my favorite things. And I think we've seen sort of the big move in SVIX upward. Stock market itself tending to trend a little bit higher. There's one more chart I want to show you. This is PCC, put call ratio, mathematics. All right. If you have 100,000 calls, and this is the S&P 500, 30 days out, this is how they figure out the VIX. 1 month calls at the money. If you have 100,000 or a million or 10 million call options and 100,000 put options, the ratio is 1-to-1. And here you can see where the ratio, generally speaking, is. It had been a little lower. Today's activity, I'm not 100% sold on. I think maybe this might be a bad data point. But if that many people jumped into puts, that is ominous for the stock market because it basically says that a whole bunch of people believe that the market's going to turn around. Now, it could be a bad data point. Not sure on that. I'll come back and look at this PCC tomorrow, the next day, just to see if there's any kind of update on that. That's a huge spike up. But regardless, PCC, breaking it down, if you have 100,000 calls and 100,000 puts, the ratio is 1-to-1. If you have a big spike up in puts to calls, the ratio may be, say, 1.2. That means 20% more puts versus calls. Now, it's a ratio. If you had 1 million to 1.2 million calls to puts in that case, that ratio would still be 1.2 versus 100,000 or 10 million, or whatever the ratio may be. That it's all the calls versus all the puts, and it is always a ratio. Then it's a matter of how much these options cost. This is how the VIX gets mathematically calculated. So if you've been wondering on volatility option strategies, figuring out what makes this move, first and foremost, it's a fact of the stock market moving. But then it's a matter of, well, how much are these options worth that people are buying that's sending the VIX higher? Then it's a matter of, well, what's the quantity? So it's valuation and quantity, and then price movement overall. Those are the three things that you really need to kind of keep in mind when it comes to volatility strategies. Given this, again, this spike up, I'm either the whole stock market sat there and said, man, we have got to protect these profits, or this is a bad data point. But that is a huge spike up. And it's really got me looking what's going on. So I'm going to be kind of looking at this on a regular basis. But next week, inflation data coming out, my take, the stock market just will not stop moving higher, despite the fact that the Federal Reserve is basically restricting the economy. Eventually, the stock market's going to catch on, and we're going to get a stock market crash. Because of that, volatility trading strategies we're going to see a spike in UVXY or the VIX. I'm looking to get in stock options, buying against UVXY. I'll buy calls, short dated. I think inflation might be Wednesday or Thursday. I'll probably buy on Monday with an expiration on Friday, expecting a pretty decent pop higher in volatility. I'll take that money and I'll run. It's not probably going to be something that you want to hold on to for a long period of time, because the market just turns right back around and heads right back upward. If I get like a 10, 20, 30% pop in whatever stock options I buy, I'm in, I'm out, I'm taking that money and running. Make sure to hit the like and follow button down below if you're just finding my channel. If you want to continue to figure out some volatility trading strategies, I look at UVXY weekly. All the time I'm putting videos up on that. Also, I have a Substack newsletter. Down below is the link if you want to follow along for that. We'll see you in the next video.